Hey everybody, we are going to talk cheap stocks today. Now, there's no set definition for what makes a stock cheap or expensive. If you ask a bunch of different investors about a certain stock, some will tell you it's cheap, some will tell you it's expensive, but I'm going to look at some of mine. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel for the best stocks to buy right now from the Motley Fool. It's the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. So let's dive right in. I want to share my screen. And for the sake of this video, I'm going to define cheap as stocks with a low price to earnings ratio. Now, of course, not all stocks that have a low PE are cheap, but if a stock has a low PE and I think it's kind of a value trap, I probably don't own it. So these are the five lowest PE stocks that I'm confident to have in my own portfolio right now. And we're going to talk about them in descending order and why I like them. Um, Number five, we'll dive right in, is Wells Fargo, ticker symbol WFC. Currently, it has a PE ratio of about 12.2. As of this writing, as of this recording, I am recording this on October 10th. Um, Basically, banking has been kind of beaten down. Their interest margins have been under pressure in the rising interest rate environment. Um, Simply put, the cost of deposits and things like that are growing faster than the yields from loans on these banks' books. Consumers are defaulting on more loans because inflation's been kind of squeezing the consumer a little bit. But Wells Fargo is doing a great job of executing in a difficult environment. And as the most consumer-facing big bank, meaning it doesn't really have a big investment banking operation, it stands to gain a lot as rates fall. Um, rates, if rates fall, consumer confidence is likely to kind of turn around with it. If inflation stays low, it's just kind of a very good environment for banks. And I think Wells Fargo is going to be the biggest beneficiary of the big banks. Um, Number four is Markel, ticker symbol MKL. They have a current price to earnings of 10.2, but that can be kind of misleading. Now, Markel is often known as like the early stage Berkshire Hathaway. They have a very similar business. The insurance is their core business. They also have an investment portfolio full of stocks. Berkshire Hathaway is actually their number one holding. They have Markel Ventures, which invests in earlier stage businesses. It's a really interesting business, but it's also worth noting that unrealized gains in their stock portfolio can make its earnings look higher than they actually are. So that is the fourth lowest PE stock that I own, but I would put an asterisk on that because of the accounting rules that might make it a little high. But to be clear, I do think Markel is kind of a cheap stock at the current price, and I would buy more right now. Number three is the newest stock in my portfolio, JD.com. They are the Chinese e-commerce company. They've rallied quite a bit lately, and their PE is still below 10. There's not a lot of faith in Chinese e-commerce stocks right now, but JD.com especially has a lot of room to grow. It's doing a great job of executing and great job of capital allocation. It's buying back its own stock aggressively. It has a nice dividend, and investors are finally starting to reward it. There's a lot of risks with investing in foreign companies like this, but this is one that I think the risk reward dynamics make a whole lot of sense for investors who are willing to ride out the ups and downs. So this is one that I just recently added to my portfolio. I've have a small position in it, um, but I like it, and I'm likely to buy more in if these current valuations hold. Number two, one I've talked about quite a bit, Dream Finders Homes. Ticker symbol is DFH. It trades for just 8.4 times earnings right now. So this is a home builder. They are what's called they use a land light business model. So some home builders will buy like a big plot of land, develop a neighborhood, and gradually sell off lots and homes to home buyers. Now, Dreamfinders does it a little bit differently. They don't actually buy any land until they're ready to build a house. They have a house under contract to sell. Instead, they will buy options on a lot of land. So if they, you know, the economic environment turns, they just don't want to build anymore. They can walk away and just kind of give up the little options premium they paid. Um, but it kind of keeps a very asset light business for a home builder, which is normally a very asset heavy business. Um, they are growing rapidly. They're based in Jacksonville, Florida, and they specialize in a lot of the big Sunbelt markets. They have a presence in both Carolinas, in Georgia, in Texas, in Colorado, and in some other Florida markets like Orlando. Um, and their focus is mainly on entry level and first move up homes. And right now we have a lot of built up demand for people who would love to be home buyers, but because of rising home prices and high interest rates, it really hasn't been a great time to do it. And the focus on entry level homes could be a real kind of benefit for this company over the next several years. So Dreamfinders, there is some risks involved with this stock. It has more debt than most other home builders, for example. They've grown a lot through acquisition, and that's kind of resulted in I wouldn't call it a bad balance sheet, but definitely a higher debt level than most of its competitors. So just keep that in mind if you're looking at this one. Um, Number one, by far the cheapest stock in my portfolio on a PE basis, and one that I don't think deserves it, is General Motors. Ticker symbol is GM. Currently, it has a PE of just over 5. That's not a typo. And that's 5 times trailing earnings and 5 times forward earnings estimates. So, pretty much, the market keeps expecting General Motors sales and margins to plunge. It just hasn't happened yet. And it doesn't look like it will happen anytime soon. And there's a lot to like about this company. Um, Out of the big or the so-called legacy automakers, you could make a great argument that they're doing the best job by far of executing on their electric vehicle strategy. There's the Cruise autonomous division, which has completely been written off by the market at this point, but I think that's a mistake. Cruise just signed a partnership with Uber to develop autonomous vehicles for Uber's ride-sharing service. There's a lot of potential in this business, and that's not to mention their kind of legacy business. There's still a dominant force in the SUV and truck market, for example. Um, Management just gave very, very strong guidance saying 2025 earnings are going to essentially match this year's levels, which a lot of people were not expecting. And they're buying back stock very, very rapidly and reducing their share count. And it's just looks like management's executing tremendously. Um, I'm a big, big General Motors fan, and it's one of my biggest investments. It's one of my cheapest investments, and it's one that I can see myself continuing to add to, especially if these valuations hold out. Um, so I'd love to hear what you think about any of these. Um, do you think these stocks are cheap, or are they cheap for a reason and I should get rid of them? Love to hear your opinion. I'll do my best to respond to any questions or comments individually, and I will see you next time. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.